হ্যাঁ করে দিন না শুরু করার
So we
পরে
are
আবার
live.
লোকজন
Yes, sir. Sir, we are live now. Pragya, please start. We are live now.
Okay, ma'am. A very good afternoon to all.
अनशेयर कर देता हूँ.
Okay, sir.
Is it unshared? Screen
Sir,
number
Pragya
share.
would start with the introduction and then you can start. Okay.
Okay, once Pragya tell me, then I will start.
Sir,
and then
you
I
are
will
live
share.
now. Okay.
Okay.
Okay, Pragya, please start the session. Then Acharya sir will take over.
Okay, ma'am. A very good afternoon to all the participants. I am CMA Pragya from the Tax Research Department. I welcome you all to our webinar today on the topic Structural Reforms in the Income Tax Act 2025. Our guest facilitator for the session is CMA Mrityunjay Chatterjee sir, who has generously agreed to share his expertise with us. He is a fellow member of ICMI. He has completed his graduation and post-graduation in commerce from University of Calcutta and also MBA Finance. He completed post-graduation diploma in tax management from IIM Bangalore. He's having more than 32 years of industrial experience in leading industry house in our country like BHEL, Bharat Electronics, SEBI, and presently he's working with Numaligarh Refinery Limited, Ministry of Petroleum, Government of India as General Manager Finance. He was a guest faculty in different Indian universities and premier B schools over the period and presently a guest faculty at IIM Calcutta. Among his multiple publications, GST Law and Procedure, Direct and Indirect Laws, etc. are prominence. Let us all take advantage of this opportunity to grow and learn together. Over to you, sir. Acharya sir.
Pragya, kindly make Acharya sir live.
Okay.
Am I live? Am I audible?
So one second. She would make you live. Sir.
He is live now, ma'am.
Sir, you're live. Thank you.
Okay. So, good afternoon. Am I audible? Pragya, just confirm.
Yes, sir. Yes.
Okay. So, can I proceed?
Yes, sir.
Yes,
proceed,
sir.
I'll just take my presentation on board. Okay, is
Yes, sir.
Screen is not coming out. Can somebody help me?
Sir, you have to have your PPT on the desktop and opened.
It is there. Desktop and open.
Yes, sir. Kindly open the PPT.
It is
and
open.
while you are taking the session, you would not be able to see any of the participants. You can only see your PPT.
Now, is it visible on the screen?
Pragya, please check.
No, sir.
Is it visible now? Has
Yes.
it come?
Yes.
Yes, sir.
Now is it visible, sir?
Okay. Sure. Sorry for the initial interruption. Very good afternoon to all my fellow friends. Definitely is a great pleasure in having a session with the most important and relevant topic as on date, That's the much awaited Income Tax Act, which we used to say it as a new bill over the time, over the months, lot of committee, lot of representation and lot of deliberation. And after that, it has actually come into picture. And only during the last week of August, it has got the accent of Honorable President of our country. It has become the act, the new act which replaces 1961. So 1922, then 1961, after that long awaited 2025. And today in this session, during the ended time that is available, what we are basically going to present, what I am going to present is the new dimension or the new velocity that has been brought into the direct tax reshaping in our country in line with the global framework or the global best practices in the direct tax frontier that is brought into through introduction of this Income Tax Act 2025. Session has been designed to basically cover the entire gamut of the law and to understand how this new act is different from the age-old which we have learned over the years, that's Income Tax Act 1961. But before I proceed, these are the all the 26 major areas I'm going to cover. But my professional friends, one thing we need to keep in our mind that whatever we have learned over the years, since possibly the day one we started our business and commerce studies and till today, right? Whatever we have learned, we have need to unlearn the entire thing or possibly the major thing. Keeping the basis remain unchanged, we have to relearn under the new tax law, that's tax laws 2025. This law has been designed with certain basic objectives. Even this was the basic criteria to go ahead with a new legislation, and this new legislation to bring in the age-old law in our country, that's the Income Tax 1961, into a reality, that's the new law Income Tax Act 2025. The fundamentals behind this law change was to bring in a simplification or simplicity. Okay, because over the years, we'll go ahead in the subsequent slides. You know, the word like notwithstanding anything said in wherein above, notwithstanding what has been told in the provisos above, number of provisos inserted over the years in a new section or every section makes the law reading become very, very difficult and cumbersome. Some of the provisos are overriding, some of the provisos cover only one subsection, some of the provisos cover the entire section, some of the provisos are notwithstanding whatever said elsewhere in this section. So this legal word framing makes life difficult for the professionals, for the industry, for the business, and for possibly everyone to have a clear understanding about the legislation, and took mammoth time to have a clear understanding on the subject. Okay. The world is moving into a easement of business. In India, enough number of government policies has been introduced, and the Indian government is completely looking forward for bringing into a easement of business or the easement of doing business in our country. While that is the primary objective, a complicated legal framework or legal wordings in the law makes the life really difficult and challenging. And that's the core objective of this new Income Tax Act, which says that its simplification in all the areas need to be carried out, and which actually been carried out. Maybe in the next slide, I'm going to present that one. Okay. The digital integration on the entire network basis, because today the entire income tax law or the administration has gone into not only faceless, over the years complete digitalization. So it is not the age-old practice of putting a manual chappa. It is all coming out with a DIN number. Everything is documented. Every activity is having a digital step mark or digital footprint, and that digital integration becomes a very integral part of the new law. The taxpayer-centric approach, that how to minimize the litigations, how to abolish the words or the sentence or the provisos which brings in ambiguity in the statute, and to bring it more transparency in the law is one of the focus area of this new Income Tax Act. And last but not the least, the global alignment. The global alignment on the international best tax practices, the transfer pricing mechanism, the rules framed and getting framed under the new transfer pricing mechanism in our country, the cross-border taxation, the double tax avoidance agreements, the advanced pricing agreements, APA, GAR. These are all the words, all the chapters of all the areas which has actually been brought into this new law to make it globally competent or parallel with and across the best practices applicable or available in the entire in the world. We before moving further, just to have an overview of this new Income Tax Act. One disclaimer I make at this juncture point, that's a number of slides, number of areas in our field further discussion. We'll be discussing or comparing with the erstwhile Income Tax Act, that's Income Tax Act 1961. In short, I define it as ITA, Income Tax Act 1961. I just defined it at ITA, while the new act is defined as ITA 2025. So please do not have this mindset ready. We need to have a comparisons. So ITA stands for Income Tax Act 1961, whereas ITA 2025 or ITA 25 stands for the new tax law. So this will percolate over all the subsequent discussions over the entire presentations. Okay. As I have already said, as this has been the basic fundamentals of this law framing. Just for the sake of repetition, streamlining the infrastructure and then the language. This is the threshold area, thrust area. It needs to be concise and integrated because similar provisions wherever are applicable and has been brought into one single chapter. Minimization of the litigations, practical and transparent oriented, and enhanced digital oversight and effective tax reforms. This is a new area, the virtual digital asset, the virtual digital framework. Even the tax law authority has now having an approach or access to the digital framework on the social media and to get and fetch data whatever are prevailing or moving in the digital network or in the digital framework. A complete new chapter. I'll be definitely discussing on that VDA and VDS, that two particular area. But this point, all of us, let us get it clarified that every union budget over the years, we used to find it out a number of changes in different sections, including one which really makes easy things, makes the life challenging. It's called a chapter called TDS, tax deducted at source. And in the entire platter started from 194A to 194H or 194 and so many subsections, provisos, notifications, and overlapping provisions. Even within contract 194C, what is contract, what is not a contract, itself becomes a subject where people even can do a research work into the TDS modalities. So a call was given from different areas of the society, from the industry, and time and again I should repeat in this forum that from the institute side, in a number of pre-budget meeting, pre-budget memorandum, presentation before the Finance Ministry, presentation before the Honorable Secretary Finance or Secretary Revenue. We have highlighted this among lot many issues. This one of the issue that there should be a simplification of the TDS provisions in the law. Okay, it becomes the really a cumbersome and everybody is finding a challenge into it. Thankful to the efforts and endeavor on the part of the institute that the government has ultimately come out in the new tax law, new tax act, a consolidated one single section in TDS, which comprises each and every activity one single section. So you need not to read from 194 to 194 I, J, K, L, all these things, right? And beautifully, which I will cover in subsequent discussions, while I'll discuss in detail on TDS, it will have it now is having a negative list of TDS, right? Means one table comprises where and how tax to be deducted, and a table which says that where tax not to be deducted. A negative list approach also has been given to make the life easy for the taxpayers, to the industry, and to the entire trade and commerce of the country. To be precise, this law has been drawn in line with the exact requirement of ease of doing business in our country. Okay, and every chapter now we take away, right? You will find it out this objective of the government, that ease of doing business, which was a call by the trade and industry, by the professionals, practitioners, and the people as a by and large, that has been reflected in this new law. What has been done? What is the major change? This is the table. Okay, I'm not telling you to go through the table, just have a look from the down. This law has become more of a mathematics based, right? You need not to break your head by reading the law and to understand one proviso with the another one with a jugglery words into it, that notwithstanding whatever written in para 1, read with proviso 2, with a sub proviso 3 inserted from 1984, with read with or in conjunction with rule numbers also, you know, these things has been done away with. Instead, there are formulas given. There are a number of areas where formulas, very clear formulas has been given how to determine the tax. Okay, and that's really wonderful. It's in line with the global best practices, which to a great extent already been followed in the GST law and the GST rules for determining proportionate tax or proportionate credit. Similar way, or the erstwhile service tax Senvat credit rules. If you can recall the formula that was to be given in the indirect tax laws, now this has been inserted in 46 cases in this new act, which include, you know, in case of a portfolio which is separated, portfolio of investment that is separated through a demerger process. Okay, that is applicable in case of tonnage tax, the gains in the tonnage tax, the depreciation in the tonnage tax. In any case of business organization, how the share of the asset be transferred, what will be the cap gains on that or cap loss on that, etc., etc. These all the chapters, all the sections is now embedded with a specific formula to determine what is and how the taxable income and tax liability thereon to be calculated. Very easy way. So possibly even the industry houses need not to refer to the consultant for these purposes, because the formula is given and nobody can explain anything beyond the formula. Number of tables has been inserted, more than 39 tables has been inserted, and the table shows very clearly that under what circumstances what will be the tax liability. What I have spoken about the TDS issues, exactly only one of the examples of the same. So in case of deductions, in case of TDS, in respect of certain approaches towards tax computations, dedicated tables has been provided in this new law, and that becomes a very helping tool, helpful tool for the for the tax user, not the both for the administrator as well as for the tax user, to make the subject more transparent and readable manner. Okay, we have spoken in detail what are the background of this entire statute. An overview. I'm keeping the entire screen before all of you. It's a synopsis. It's a synopsis of how it has been made. If you recall the erstwhile Income Tax Act, that is the ITA, and please repeat this thing. Time and again I will repeat because some of my professional friends may join in between also. ITA stands for Income Tax Act 1961, and IT 2025 stands for stands for the new act. That is the act which was a bill a couple of days before. Now it has become act. So that shows ITA 2025. Okay. Few things that I have already said now is appearing over here. It actually came out from certain case references, certain court judgments and verdicts, wherein this what has been strongly objected by the legislature, by the judiciary. They said that notwithstanding is a non-obstant section that is usually employed to give a overriding impact or overriding effect to certain provisions over some contrary provisions. So if there are contrary provisions or contrary discussions, then on overriding the what can be used that notwithstanding. So if the objective of the lawmakers or law framers or the trade and industry and professional bodies is that to make the law simple, then overriding and contradictory provisions are not expected to be there in the entire law. Accordingly, this word in the entire book, the word notwithstanding has been replaced by the word irrespective of. So wherever there is a contrary, there is a confusion, there is something to be clarified, then this word need to be or is being used called as irrespective of. Some new thing has come. Over the years, people, the persons, the professionals who are regularly dealing with the tax, for them previous year and the next year, subsequent year is the assessment year. It's like a very common. There is nothing great thing for them. But for the normal industry, for the industry leaders or industry houses who are the non-finance guys, non-finance people, a lot of time people get confused over the assessment years and then the previous years. So this year we are filing an income tax return for 25-26, whereas the previous year, the financial year remaining 24-25. So this anomaly which was there, which was framed under certain beliefs and faith in the year 1961 and amended time and again, now had seen or going to see a new light with this ITA 2025. It uniformly going to say tax year, right? Tax year. So what is a tax year? Like financial year, it becomes a tax year. Financial year 25-26, tax year 25-26. Okay, and it commences from the 1st of April. So the financial year in one side, it's correspondingly it will be said that tax year. The confusion, contradiction of a previous year, assessment year. Okay, this will be all done away with, effective from 1st of April 2026. And once again to say that we speak about the global best practices. Obviously, in the cross-border taxation, in multinational taxation, in the taxing of the non-resident or taxing of the non-resident in India, cross-border TDS, transfer pricing, advanced pricing agreement. These are the things where obviously the best practice of the world is already embedded. It started embedded from 2021. Now by 2025, the entire OECD guidelines is actually embedded in the new tax law, in the new tax act called as 2025 Act. So the best practice of the world is now in our country so far as direct tax is concerned. Few small changes, then again I'll go into the detailed changes, big changes. But please remember one thing more once again for repetition, like tax is going to be levied on income. Okay, fundamental basic structure remains unchanged. There will be always there are earlier also 5 heads of income, right? It will remain as 5 heads of income. So there is not a big change. What is the change? What are the changes? That where the words lead to a confusion, where the words lead to a contradiction, right? Between the tax authority and then the assessees, that is abolished, that is being taken away. So hopefully in future the uncalled for legislative differential views, uncalled for confusion and contradiction would be avoided or could be avoided. For example, the existing act says what I have written. I am not going to reread it. I think that the screen is visible, so you can have a look. It says that if during the year for determining the residential status, that one of the condition in the section that condition to stay in India for 60 days or more in the current year does not apply to an Indian citizen who leaves India for the purposes of employment outside India. This was the ITA, that is the existing, oh sorry, I reframe my word. This was the language for ITA 1961. Okay, both are income tax act, so sometimes this confusion or overlapping will continue for a couple of days. The purposes of employment undergone a number of situation which calls for the matter referring to the courts and high courts. Why? What is the purpose of the employment? See, we did the law. We did the law according to our requirement. Whenever in a particular sections where we find challenging, we try to read the law to the extent it becomes favorable to our side. Our side means it may be the assessor side, it may be on the departmental side, either way. Okay, so for the purposes of employment, it has been replaced by the word for the employment outside India. What has been taken out? Purposes. You may find that it is what is the significance of it? The word purposes only has been taken out. What it makes difference? Why? How it different from the erstwhile act, old act, 1961 act? Pe kya aisa tha? But fact remains, the purposes of employment and the employment are not the same. You have went for certain things in relation to the employment or towards an employment. This small word makes a big difference. Towards an employment, purposes of employment. Okay, so whether employment in India and certain work in relation to that or for the purposes of employment abroad, whether they qualify for that 60 days criteria for residential status, that was challenged in number of court judgments in the country. I'm not going in this forum for the legal judgment analysis because this is not the right forum also. But yes, that's the fact why these small changes are changed with an intention. Because if you remember the very first or second slide we have spoken, the core objective is simplification to make the life simplified under the new tax law, right? 2025. This is one of the changes. Okay. I just say a glimpse of the word, or rather I will read only the first paragraph and the rest portion you can understand of your own. It says where all operations are not carried out. This is the income deemed to accrue or arise in India, section 9. But the deeming concept, accrual concept, and actual receipt concepts are embedded in section 9(1), 9(2), etc. And where it is said where all operations are not carried out in India, right? The ITA, that is the erstwhile law, ITA is the Income Tax Act 61, requires that the profits reasonably be attributable to operations carried out in India shall be deemed to accrue or arise in India from any business connection. Full stop. This language is already embedded, already crept in section 9. And we are dealing with this section 9 at least for so many donkey's years, at least for last 20 years, we're dealing with this particular line. The issue arises that what is reasonably attributable and how that is to be determined. Who is going to determine whether that determination of income is challengeable or not challengeable? Matter becomes debatable. Matter becomes a confrontation between the assessee and the assessing authority. For the new act proposes, the bill which was placed and which becomes the act, the ITB or ITA 25, it proposes that to remove the word reasonably. The word reasonably, this word has been moved out, taken out. Okay. The suitability of the computation of the profit, it seems so it becomes a complete responsibility on the part of the assessing authority also to find out, to calculate out the profit arising from a business connection attributable directly in respect to the operations carried out in India. Correct. So it's not just by allegation, not just by saying that something is reasonably attributable. So the basis of reasons was not required to be written in the assessing or assessment orders. Now you have the assessing of authority will have the complete transparency in determining the order and determining the tax liability thereon. What is expected in this, that a number of rules are getting framed. Towards the end, I will speak something on the rules or rules framing, and then how the institute is also contributing in that process. I will come towards the end, but let's go ahead. So a rule is expected to basically address this sort of a situation where reasonable attributable or reasonably attributable is going to be exactly attributable. Okay. I think in other provisions also it has been there on the similar section 9. So I'm just keeping this one because this particular point we have already covered. Any of your questions coming out from section 2 to section 9, which we have covered so far, right? May please forward the questions if you have up to section 9 any questions, because we have covered up to section 9 till now. Section 9 of erstwhile law, that is the taxability, chargeability provisions. Now come to the exemptions. Okay, there are schedules, specific schedules has been given. Instead of a long and chronically prolonged long list of section 10 towards exempted incomes, okay, a table has been provided. Okay, and these tables with this specific schedules, 7 schedules, it covered the areas which are who are the assessees and what sort of incomes are exempted. Example, it's like exemption to the non-resident. So a non-resident where the incomes are not accruing, under what circumstances, what are the basic characteristics, what are the preconditions need to be fulfilled for treating the income as a non-taxable or exempted income for them is covered in the Schedule 4. Similarly, business trust, sovereign wealth funds, etc. To be precise and honest, this time this law has come out with a specific and very, very clearly defined provision, a chapter on the non-government enterprises or non-government approach or non-profit organizations, in short called as NPO, non-profit organizations. Taxability on the NPOs, the restrictions, the challenges on the NPOs, that also has been crept in the new act, which will be very, very useful for the exempted trust or exempted educational and charitable institutions. A specific dedicated provisions has been included now. It's not scattered anymore. Okay, now I'm going rapidly to to understand few interesting changes in the respective heads of income, like salary, house property, business profession, cap gains, and other sources. These are the 5 which was there earlier, which remain there in the new law also. Okay, there are tidbit changes, there are important and insignificant both side changes are there, but I'm only taking out only 2 or 3 which may be of important to all of us. Okay, it said if I read the second one, the first one, if I read the second one, all of you please have a look on the second point. Medical treatment for prescribed diseases provided to an employee or his family members in an approved hospital is not a taxable perquisite. Up to this, everybody is with me, right? Everybody, because this is, we know that if the treatment is made in the government hospital or in the hospital run and managed by the employer, or if the hospital is approved as per Income Tax Act by the Income Tax Authority, right? And the medical treatment of a prescribed, underline the word prescribed diseases in an approved hospital. Done. It is not treated as a taxable perquisite, provided. Now here the catch. Provided a certificate from the hospital and the payment receipts are attached with the return of income. Done. Now this new bill, which now converted into act, it proposed and it actually happened that this provision of this certificate, attachment of this certificate from the hospital, right, that has been done away with. That has been done with this. So it becomes really helpful for the common associates, common people or the employees. Reason being, to get the certificate, the employee need to run around maybe different sections or department of the same organization, or may have to run to the hospital to collect the certificate issued by the Income Tax Authority to that hospital. Okay, it's no longer required now. The reason being very simple, because of the digitalization. Because the application of that hospital is processed digitally, the certificate is in a digital platform. The claim comes with the hospital name and code number. With the code, if that digital codification tallies, automatically this claim will be allowed and there will not be any more questions. So why a physical certificate to be taken? So the point of core objectives of digital integration starts every framework of the new tax legislation. Wherever possible and feasible, the lawmakers has emphasized that no more physical document to be taken. It should be only and only the digitalization in the center process. Okay. This is on the medical perquisite. One more perquisite example I'll take, and then I will skip the salary because such small changes has already number of changes has been encrypted. I just request all of you to look into the point number 3, right? And the other things are definitely all are available in the sections in the provisions. Okay. It says that an employee uses a vehicle provided by his employer, underline the word, provided by his employer to commute between office to home and home to office is not considered as a taxable perquisite, right? The new law says, okay, see, let me read out what the new law says. It says that any expenditure incurred by the employer, the word now change, any expenditure incurred by the employer for an employee's commute on the same route shall not be treated as a taxable perquisite. What is the difference? The difference is that most of the employer in the country, including the government departments, right, they are doing away with keeping their own vehicles. So everywhere you will find it out, even in the government department, in private, in PSUs, in government sector, private sector, we are getting yellow board vehicles, but not white board vehicles. So the vehicles, the word vehicles provided by the employer right, has been replaced by the word expenditure incurred by the employer for commutation. So that means to say that even third-party vehicle, right, in short or in common word called as the YOLO board vehicle, taken by the employer for the purposes of used by the employee for commuting the journey between the home to office and back, not to be treated as a taxable perquisite, and the change is actually in line with the trend that is being followed in the industry across the country. Interesting part on the house property, which may be important or maybe quite interesting for the people or for the ordinary common people. Okay, if I take the last one first, the property laid out in the normal course, the actual rent received is considered as the annual value, which is very common thing. There is a formula of annual value, section 23 of the present act. If the property remains vacant for a period during the tax year, right, the new law proposes that there is no need to compare the actual rent with the expected rent. Today there is a big computation under section 23 subsection 1 and other with read with the entire provisions of the house property, which says municipal value, then actual rent, then fair rent. All these complications are there, and then comparatively a higher value shall be considered as the normal rent, as the actual rent. So if the property remains vacant, whether for the full year or for part of the year of the tax year, the comparisons of actual rent with the expected rent need not to be done for the purposes of determining the taxable income from house property. It's definitely a good proposal for the persons who keep their house vacant or who are compelled to keep their house vacant because of so many reasons, including reasons like staying in other places because of the employment or business, something that like. This is definitely a welcome business, welcome change. Okay. On business income, few changes. On cap gains also there are few changes. Okay, I'm also only picked up which are relevant relating to all of our common purposes. Only a few one. Okay. Section 43B as on today. Section 43B as on today of the Income Tax Act. ITA stands for, once again to repeat, 1961 Act. 43B says that certain payments are only allowed if it is actually paid, if it is paid in cash. Okay. The new law proposes that tax includes a surcharge for deduction, because there are the word says tax payable. So here it says the tax includes a surcharge, and it is covered under new section 37, which was clause 37, now become 37 in the new Income Tax Act. Okay, where it says certain deductions allowed on actual payment basis only. Okay, so similar controversies arisen in other relevant provisions of 48(2), which was settled, and wherever there is a tax or similar payment are allowed based on actual payout, not only on provisions. Everywhere section 37 is an overriding one which covers and clearly states that tax includes surcharge. So there should not be any difficulties into it. Okay. The new Act, ITA 25, it clarifies that the tax paid on any income, including foreign taxes eligible for credit, cannot be claimed as a business expenses. This is a very interesting one. That the new Act, it clarifies that tax paid on any income, because tax paid cannot be treated as a eligible business expenditure. Okay. What was the gap? The previous, that is ITA 61, Income Tax 61, the present or erstwhile Act, it says only taxes paid on profit and gains from business or professions were not allowed as a business expenses. Something like what happens, my professional friends. It's like over the period of time, certain conception becomes outdated, outlived, and a new conception begins because of the globalization or changes in the business paradigm. Here also it is same. Earlier it was said that the profits and gains from business and profession only if it is debited in the PL, it should be treated as a non-allowable business expenditure. The ambit has been extended. Okay, and it said that including a foreign taxes. So if a tax is paid in a foreign country, there is a further clarification also in ITA, which paucity of the space I have not mentioned, that that foreign taxes, even that foreign tax payment, if it is eligible for a tax credit in our country due to the protocol arrangement or due to DTAA arrangement or due to any other tax treaty arrangement, despite all these things, even if it is debited in the accounts, it shall be treated as a non-eligible business expenditure. Okay. On depreciation on intangible assets not fully used for business. If intangible assets like a right is a royalty or a technical know-how, if it is not not fully used for business, it should be allowed only on proportionate. I recall a particular word which I told very beginning of this discussion at the beginning point, that there are a number of formulas has been given in this law. You will find it out if you did this new take the new act or go through it. You will find it out number of papers, number of pages. It is written A divided by into C, C divided by B into X, etc., etc. So in all these cases, the depreciation, this is one of the point where formulas has been given that how to determine what is the eligible depreciation and what is non-eligible depreciation. Now, Asus is engaged in 35 AD and others. I'm not going. It is also in line with 35 AD with certain small changes that is mentioned into it. Any type of export incentives are covered under the scope of business income. So you get any sort of duty drawbacks benefit, you get replenishment benefits. These are all treated as income equivalent and corresponding to Section 28 of the present or existing erstwhile 1961 Act. Okay, so you don't have any exemption or a reduction from the statute. First part I have already covered. So the second part, something interesting here. Very small changes, very minor changes may be having a big impact. Let us understand what the present ITA says. ITA means ITA 1961. 44 AV deals with tax audit. And it says that if the total turnover is rupees 10 crores or less, or at least 95% of the receipts and payments are done through banking channels, okay, tax audit is not required. If these two cases, right, this is the conjunction clause. It's turnover less than 10 crores and at least 95% of the receipts and payments are done through banking challenge. What the new act ITA 25 says that the exemption criteria remains the same. Exemption criteria of 10 and 95 remains the same, right? Provide that receipts and payment from business will be considered for 95% threshold. This means receipts and payments are not part of the core business operations. Example, even if dividend and interest income will not be included in determining whether the tax audit is required or not required. So ambit becomes slightly wider for determination of the eligibility in respect of tax audit. Okay. In short, cap gains, 2 or 3 big changes, interesting and important changes. The new act proposes that a non-resident to compute long-term capital gains from unlisted shares and debentures of Indian companies in foreign currency, invested in foreign currencies. There was certain ambiguity whether it is 10% with indexation, 12.5% long-term capital gains, including the unlisted shares and debentures transferred by a non-resident. That was a area where number of controversies, number of judgments has come up, that non-resident investing in a unlisted or non-listed instrument, okay, unlisted shares and debentures, and transferred it, but did not allow the benefit under the proviso of the indexation. So now this section new act gives a complete clarity that the non-resident can compute long-term capital gains from or arising from sale of unlisted shares and debentures of Indian companies in denominated foreign currencies, even the transaction takes place, and tax benefit should be allowed. Okay. Last and not the least, number of changes in the capital gains. Okay, itself it's a subject matter of discussion in a full-length seminar, because all the changes that's taken place here and there in the capital gains chapter. I take up only 2 or 3 important. The last one, let us read it. That an assessee becomes ineligible for Section 54F exemption if he purchases an additional house within 1 year from the date of transfer of the original asset. The time limit was 2 years. To withdraw the exemption already claimed if he purchases another house within 2 years. Okay, so this exemption limit from 2 years and 1 year, the new Income Tax Act proposes to keep a 2-year time limit in both the provisions. That means you have now the longer time frame for investment under Section 54, equivalent to 54F, right, to basically bypass or basically save the capital gains taxation that arises on transfer of assets. The most interesting part, or similar number of interesting areas have taken place in this new law. Interesting part is on salary. All the TDS rates, threshold limits, payment, nature, areas, right? These are all given in one single table. Section clause 367, now section 367. This particular section itself is having a table. So you need not to read the act with the rules, with the tables, with the chapter, with the provisos. Nothing. One single section is sufficient. Okay. All type of TCS provision 206, C1, C2, C1, Roman 2, Roman 3, all now consolidated one single table. Okay. Lower certificate of TDS and CTS is available for all payments. So it's not like that lower deduction certificate. If any one of you read that the lower allowances of the lower tax credit certificate or TDS certificate, the provision, the assessing officer is authorized to issue. After that section in the present law, it covers all the type of sections 194, 194A, etc., but 192 is not there. Similarly, there are few sections that are not there. Okay, so the existing law is like a exhaustive. It covers all the sections. The new law, 25, it says lower TDS or TCS certificate is available for all payments. Okay, and that's all about the TDS provisions. It's really a well-deserved change. It's basically a taxpayer-centric approach. This is one of the third pillar of the core objectives of the new tax law. Okay, if we think and if we just repeat the core pillars for this new tax law 25, right, Income Tax Act 25, and when the bills were proposed, when the discussion with different committees and business trade industries took place, the 4 pillars was determined. One was simplification, the second was digital integration, the third was taxpayer centric, and fourth one was the global alignment. So this definitely is a taxpayer centric. where taxpayers are getting immense benefit, and even by ignorance also people cannot make a mistake, because the latest changes are appearing or shall appear in the table itself. Okay. Nothing very big change in the filing of return point, but slowly I will move into the virtual digital area of VDO and VDS, where the digitalization process will require mandatory filing of the returns. But here it says that there are certain situations in the 7th proviso of the ITA. Very interesting. ITA is the 1961 Act. So many provisos in so many sections, okay, including, my friends, if you look into the one of the easiest chapter of Income Tax Act 1961, called as, say, section 32. Okay, that also speaks of, that also covers a number of provisos to determine what is the block value, how the depreciation to be calculated, whether the depreciation is mandatory or not, whether you can bypass the depreciation computation under 32, whether depreciation is an allowance or not an allowance, etc., etc. So this 7th, 8th, all these things have already been abolished. These are all old Act ITA. Okay, but there were certain circumstances where mandatory filing of the ITA was reported in the law. Okay, like foreign travel, certain turnover, gross receipt exceeding some threshold limit, etc. One sec. The board has given the power. Now the board has been given the power to specify the limit and the condition upon which the return filing will become mandatory. So once again a table, once again a schedule, and then table and schedule will be updated from time to time. So the taxpayer only need to refer to that table to find it out. If the threshold limit exceeds, he or she need to file the return, right? You need not to read in number of provisions thereof and explanations thereof. The board has also been given the power to seek the details of credit card held by the associate's expenditure exceeding the threshold limit, outgoing particulars, principal place of business, etc., etc. So there were a lot of time a word came out, a provision came out, a concept came out during the discussion on the IT bill, income tax bill, before it going into the parliament and getting the approval process, that should it be a income tax oriented or income oriented tax, or should it be an expenditure oriented tax? Because at every point, every forum, if we speak that it is a expenditure oriented economy, means more expenditure means more velocity of money, more indirect taxes, more flow of income, and more flow of income means more income tax thereon. If that is the clause, if that is the call of the economy, then should we go for a expenditure oriented taxation or not? So something has been crept over here. That is, if the expenditure exceed the threshold limit in the credit card and others, there may be a question, right? There will be a reasons, there will be a call by the assessing authority by virtue of the board direction to call for the information and ask for filing the return thereof. Okay. On the assessment and the inter-assessment process, significant changes that has not taken place. So by and large, assessment, the reassessment, income escaping assessment, by and large remains the same, excepting the valuation officer referring the matter whenever there is a dispute about a number of situation that is crept out in this particular law, which internally includes situation. The situation like determination of the value of the shares and bonds or the securities for the purposes of valuation, particularly in case of unlisted shares and debentures and other securities. Today also there is a provision 269 onwards, and tomorrow, from ITA 25, the power of the valuation officers to estimate the value of the asset is defined within the provisions. Okay, what are the powers? What are the areas? And the details modus operandi is going to be published. That what are the process and steps would be taken towards valuation of that assets. On the reassessment, rather few important changes have taken place. Reassessment, section 147. Okay. Let us understand what is the present law. Just recapitulate what the present law says. The present law says that the AO can assess or reassess all those income that has come to his notice. Okay, subsequently in the course of proceedings, even if the procedure prescribed under 148 is not followed. So that means in short, if you can have a look into it, but I'm repeating, 147 is the income escaping assessment, and during the assessment, if the assessing authority has come out with something, right, or something has come to his notice that certain income has or possibly has escaped, he may call for the information, call for the details, right, as prescribed under 148A of the existing Arts 12 1961 1961 Act. Okay, now this the new law expands the scope of the term information. Okay, to initiate the the reassessment. It shall also include the directions given by the approving panel declaring the arrangement as an impermissible avoidance of agreement, and an order passed by an authority in any proceedings under this act under by way of appeal, etc. That means in short, the power and authority of the assessing officer under 147 read with 148 have wide escalated to cover up any areas or activities which comes to his or her mind during the course of assessment, and to understand, to get convinced that certain income has escaped. He or she may look forward for the information further to initiate the reassessment entire process. Okay, and to just to add further instrument into it, so that these are the purposes for a better tax administration or a much wider tax administration. 148, that is the proceedings before reassessment activity. In that case, the any arrangement which is impermissible or avoidance, etc., that need to be covered or that need to be taken into consideration. Okay, this entire thing has to be covered under e-verification scheme 2021, and now with the digital framework has become a much wider sense under the reassessment entire process. Okay, 148, I'm not going into more litigations because the law is just going to start from 1/4/1961. Hopefully, with the new legislations, with the new benefits crept in the law, maybe the income assessing attitude of the assessors may be done away with. So even though the law become very stringent so far as reassessment is concerned, including the law of limitation, the timeline for the reassessment is concerned, it is expected by the department that the reassessment cases will substantially expected to be coming down. In case of block assessment, the order for block assessment must be passed within 12 months from the end of the month in which the last authorization for the search and requisition was executed. That means now there is a specific time limit. What is block assessment? The assessment for a particular block, maybe 5 years. And after a particular search and seizure activities have taken place, the complete in a block, the assessment takes place. Now there is a deadline of time, and within 12 months from the last authorization for a search or requisition, which was executed or carried out, from that, within 12 months, this job need to be completed. Block assessment. Come to penalty and provisions, but more interesting part, let me cover it, and then if time permits, I'll come to the penalty provisions. The most important part is search and seizure, and then the globalization of the global approach of the direct tax laws, because we look for the law changes, the conception of background changes of the law. Okay. Now, in case of search and seizure, so many days from 1961 to till date, it says that the books of accounts or other documents or any other information stores in electronic media or right. So the erstwhile concept of books of accounts and the documents now has been widened to include any information stored in any electronic media or a computer system. So even the tax authority or the search and seizure authority used to catch hold of the laptop or other digital devices for the purposes of search and seizure operation. The new section has defined very clearly what is a computer system, and if all of you have a look what is written in the para 2, the second para here in this slide, you will find it out. Possibly anything and everything is covered. Possibly everything and everything is covered, which says computer resources, communication device, digital or electronic data storage device used on standalone mode or computer system, blah blah, which possibly whatever, including the cloud server or virtual digital space, everything is covered within the definition of computer system. And in a search and seizure procedure, this everything can be taken into the custody of the authority for the purposes of the effective search and seizure operations. Now, two important point I will discuss this. This virtual digital asset is already there. It is nothing very big, but it has enlarged. That means it is not only the physical asset and transfer of physical asset to determine the cap gains and tax thereon. The virtual digital assets, right, which includes or generated through cryptographic means or otherwise. Today we are quite versatile with the cryptography or cryptocurrencies, etc. But tomorrow some more algorithms may come out. New algorithm feature may come out. Okay, which may be called by any name. If you read the definition, it says that any information or code or number or token, okay, whether in Indian currency or foreign currency, कहाँ से generate हो रहा है? Generated through the cryptographic means or any algorithm which brings out such a token or a number by whatever name called, providing a digital representation of the value exchange with or without consideration. Okay, the entire thing is now covered within the ambit of the new Income Tax Act 2025. Okay, non-fungible token or any other token of similar nature, because law is also not very clear what algorithm in the high-tech computer science may come out with a new digital token system which may be negotiated against a certain amount of foreign currency or maybe some other means, and through which income may be transformed from one economy to another economy. A crypto asset being a digital representation of the value that relies on a cryptographic secure distributed ledger normally called as blockchain ledger, or a similar technology to validate and secure transactions, whether or not such asset is included in subsection ABC above. So anything which may come beyond the conception as on today, आज के दिन में whatever we are able to think, if something comes beyond that, that also is covered within the definition of the virtual digital asset. And VDA is a part of the taxable entity in or as per the new ITA 2025. This is good. This is even acceptable. What is very, very challenging is now this. I just request all of you to just go through this ITA section 261. It's called virtual digital space. Okay. Today, my friends, anyone and everyone, we are in the social media. We have got multiple social media account, LinkedIn, right? WhatsApp, so many. Okay. The investments, nobody today does a manual investment mechanism, online investment account, trading account, digital account, whether for shares, debentures, bonds, etc., etc. We keep the data not in any folder in our laptop or in our palm top. We keep it in certain storage facilities, no, in a third-party storage facility. Even people use this cloud for keeping their confidential data records. A remote server or cloud servers. People pays money to hire a space in the cloud and keep their data and investment details in the cloud. So even under any sort of a income tax such and scissor or rate, very difficult to retrieve that cloud details. Okay. So a law enabler needs to be required. A law enabler also required, right, to trace out. I repeat this word. This is what is going to happen, or it's already rather going is actually happening, right? I am having number of assets, properties, the new vehicles, investments, etc., etc. Some of the social network or some of the confidential network, I'm keeping the data. If I purchased a new very high-end vehicle, I may put it in the social media, tag on with so many other people. If I have got an investment which is not to be disclosed to everybody, is kept in a confidential server or maybe a absolutely covered cloud server. In any of the situations, if there is a AI-driven some mechanism which already government has already implanting in its technological server, that for me, what my social media account or my investment account, digital media or my cloud media, what new informations are getting covered. So that's horizon, that huge platter, right, is called space. So it's called as virtual, means no physical space, virtual digital space, right? And any information available over there, the assessing authority, the tax authority has an access legally to approach or penetrate that platter to get the details and then do the needful as per the statute of the country. Okay, that's why VDS becomes so important for a lot of people in our country or abroad also. This is once again the global framework of digitalization of the entire tax administration process. So it's not 20 rupees ATG certificate or 10 rupees medical voucher or 200 rupees LTA voucher. That's not the lookout of the tax authorities. Their lookout is that how that's trillions and the big amounts are bypassing out. Digital space, if you read, just spend a couple of seconds time. This is very interesting, very important. It means an environment. Tickets. So it doesn't mean it is a file. It's a document. It means an environment, an area that is constructed and experienced through computer technology, that is through an algorithm, and not the physical tangible world, which comprises any digital realm that allows users to interact, communicate, and perform activities with the computer system, computer network, computer resources, communication devices, cyberspace, internet, World Wide Web, and emerging technologies. We do not know what technology in web will come out. Using data and information in the electronic form for creation or storage or exchange, and includes 1, 2, 3, 4, 5, 6, 7 on the right hand side. So possibly up to 6. We are aware up to digital application platforms. Yeah, 7 is not known. What is going to be come tomorrow, that will be included here in 7. Any other space of similar nature. So if cloud is blocked today by the tax authority, if the in search or any investigation, if cloud is attached, then I may find it out something beyond cloud. Some new algorithms may come out now. Some new digital places may be defined. This everything is covered within the definition of virtual digital space, VDS, right? My professional friends who are in the profession or practice, having their customers who are digital, who work in the digital network, absolutely. Maybe individual, maybe corporates, maybe the fintech companies, maybe the technology-based companies in a different part of the country. The professionals do have definitely a much wider opportunities because VDS such a wide thing, right? Covering the entire income arising from the VDS, read with the global standards which is coming out from OECD guidelines, will be a new area for the profession so far as the tax practice is concerned, right? This is the new options that is coming out. DTA I am not taking up because there are certain changes, but I am expecting after the geopolitical situation presently going on across the world, in which India is one of the important party into it. So India, US, India, USSR, India, Ukraine, India, Pakistan, you know, these all number of DTAs will have a relook definitely in the process, and we'll have a different session on the DTA provisions. Okay. Now come to the globalization. The rest of the time we have in this session will cover up in this area, in this space, because this is the area where the institute has given a huge representation before the ministry, and in number of situations, the then president of the institute and the team with him, they have represented a number of avenues to the finance ministry, that how transfer pricing defined as per the OECD guidelines across the world is utilizing the accounting or the cost accounting framework of the country, of the institute, and determine the taxable value or the gaps in identifying the prices between the assessee and then the assessing authorities. This is a long drawn story. Only right, the institute's untiring efforts going into it to determine or to say about the process and procedures so far as the ALPs are concerned. So as the ALPs are concerned, I just repeated something over here. In the present statute of ITA 1961 vis-a-vis ITA 2025, the changes that has come into this particular area or this particular provisions is obviously after the prolonged approach or prolonged follow-up by the institute, and where it was said that even there are few methods like now cost plus method, profit split method, etc., to determine arm's length price, right? There should be a clarity in the process that how this price is going to be determined and how it will be binding on the assessee and the assessing authorities without any further dispute. Because my friends, we are determining the price, right? A beautiful amendment has silently come out in this new statute, and it says, I just read out, which is not coming in the picture in the slide. I'm just read out from the section. In the section subsection 5, it says the assessing officer, before determining the arm's length price under the subsection 4, means that all the 5 methods, no, the profit split method, cost plus method, the comparable compare CUP method, etc., shall give a notice calling upon the assessee to show cause on the why arm's length price should not be determined on the basis of material and information or documents in his possession. So here the ALP application may not merely be a quantitative, what I have written in this screen, what is visible on the screen now with the underline in the middle of the screen, is that the entire ALP computation should not merely a quantitative, it is more of a qualitative exercise. And number two is that in this entire process of qualitative concept, there is another section. There is another section. Just one second. The assessing officer on determination of the arm's length price under subsection 4 may compute the total income of the assessee having regard to the arm's length price so determined. So with the full detail, with the background, with the cost analysis, with the revenue analysis thereof, which are really read in conjunction with the cost accounting standards, CAS, right, would definitely give a better platform to the assessing authority as well as to the assessees to determine the exact ALP which should be accepted by both the end without any further dispute. Okay. My professional friends of ICMAI, now to everyone, my submission from my side that while Institute is providing a tireless effort, right, untiring effort to provide the details for bringing out a better quality rules which will be published by the government in a short period of time towards arm's length determination of transfer pricing under the Income Tax Act 2025. Any good suggestions thereof may please be forwarded to the tax research department of the institute for its review and taken into the system. Okay. Advance pricing agreement, these are all once again, it's a continuing factor based on the global best practices as per the global standard or international standard or OECD Article 15 that is being practiced across the world on the APA mechanism. Okay. What I told at the very beginning that there is now a completely a new chapter on the charitable institutions, and this charitable institutions, right, they called as a registered non-profit organization, in short NPOs. It replacing the very varied terms like trust, institutions, university, hospitals, etc., which are primarily covered in section 11, 12, 11A of the existing provisions of the Income Tax Act 1961. Okay. A complete new chapter with a completed 2 tables has been inserted therein. So, friends, if you recall these words, that the trust set up solely and exclusively for education purposes, for charitable purposes, etc. The income arising at least 75% should be used for charitable. That is all the conditions for exemption under section 11 and 11A, etc. These are all going to be merged, not going to be, these are all been merged into the new chapter called as NPO in the ITA 2025. Okay. It is why it is so useful and helpful, because all the provisions, section 11, 12, 12A, 12AB, 13, 115 BBC, 115 BPI, 115 TD of the existing act, this all has been consolidated in one single page or one single chapter. Failure to maintain books of accounts, file of tax return, conduct of the tax audit, result from the tax, etc., taking the permission. These are the procedural issue which is already there. Also going to be there. So there is not a question, that is not an issue. What is precise issue is that today all the different sections has its ambit outlook, which are different from one to another. One is different from 11 is different from 12, 12A conditions are different from 12AB, etc. Now we have, or we are going to have, one single chapter for all NPOs. That will be really helpful for tax practitioners as well as for the associates who are going to have or who are having a trust exempted in category like institutions, university, hospitals, etc. And this is once again in line with or aligning with the global or international best practices, right? The share of trust or the taxation of the trust. One or two slides, then I keep the house open for any questions. Very specifically, the scope of search and seizure has of the empowering authority has been enlarged to any computer system, because we have discussed two very interesting points: VDA, virtual digital asset, and VDS. VDS is like a open universe. You can have anything and everything. You can have anything and everything in the VDS, and assessing officer can fetch into. They can track. They can tap any of your digital network, right? Whatever we are doing from the laptop or from the mobile and others, we are not very sure as at this point of time that what are the devices going to be tapped or touched. But yes, it will have a big impact for the persons or for the people who are digitally managing their investment portfolios beyond the knowledge or beyond the ambit of the tax authorities as on days. Will definitely have a difficult and challenging time, and the search and seizure procedure covers that thing very clearly, that these all should be covered within the ambit of the tax direct tax structuring. Okay, that's what we have said, that every point, every line in the search and seizure process, right? The ITA 25, that is the Income Tax Act 25, adds computer system, bank lockers, bank account, list of assets, and include the digital space, electronic content, records, communications found in the computer system, which includes cloud and cloud, any computing in the clouds. Okay, I am almost close of my discussions on the search and seizure, maybe one or two. These are all on the digitalization process. So in short, while benefits or exemptions been extended, unnecessary uncalled deduction which calls for litigations. You know, my professional friends may recall that number of 80s chapter 6 deductions, which precisely call for confusions and confrontations between the tax authorities and the assessees. The moment I claim 80 IA or IB or IC, right? Obviously, I am inviting a question from the tax authority and vice versa. So once simplification is taking place in the area of the tax framing or law framing, more and more digital integrations are taking place so far as the tax administration is concerned or documentations are concerned, while the tax payer oriented or the industry oriented or ease of business oriented amendments are taking place. At the same time, the global alignment for global best practices to bring in the country is is being made in this new tax legislation. The transitional provision says that if there is a existing holiday being given or existing tax credit, some promises being made, that existing one under 61 Act will pari passu applicable and transit to the new sections, the new law that is under the repeal and saving sections. Repeal and saving sections. Finally, before we close, the takeaways that this legislation was thought for so many years, and once this bill was drafted, the trade associations, the institutional professional bodies, and our institute, right? They have all jointly given or individually, severally given number of these things, suggestions, and I'm really honored to say in this forum that the suggestions, particularly that we given this institute, we on under the leadership of the Honorable President, we have given to the Finance Ministry a number of things, particularly abolition of the unnecessary deductions or uncalled for deductions, simplification of the TDS, the global TDS, and the very simplification of this thing of the transfer pricing mechanism and APM mechanism. That has all been accepted. We are looking forward for more participation in this law and rule framing process, which are in the process to come. Okay. So I'm coming to end of my entire presentation, and certain questionnaires definitely would be there. I am hopeful to get the questions. One thing to say before I say formally thanks to all of you, that yes, it's a continuous endeavor to break the ice and to have that relook into it. For the stock evaluation, we were there. Our institute members are still there. There is no doubt into it. But the areas of the TP or on the global pricing or advanced pricing, whatever language being framed in this new law, definitely gives the way to look forward to be part of the entire direct tax frontier by our professionals. And with that hope and expectations, I'm signing off this entire discussion and putting forward the audience for any questions. And any questions you have, you may provide me in my personal Hotmail number, personal email number. Thank you, and thank you everyone for giving me this opportunity.
Sir, we have a question from Mr. Vaidyanath. He says that he actually asks for your opinion. It is like that according to the data shared by the government in 2023, only 2% of the population in India are income taxpayers. Are they planning to introduce direct tax code in the next financial year, or do you think that the simplified version of this Income Tax Act or direct tax code can make tax laws more equitable, transparent, and have more number of taxpayers?
Sir, your question is well taken. I think these are the matter being discussed over and over the period of time. But to be precise, direct tax bill, this income tax bill, which was proposed and which was announced 2024, then this bill has seen a number of discussion forum across the country, across the different media, and it has come to a conciseness from the trade and industry and every aspect. It covers possibly every side, including the OECD guidelines, which is the global best practices followed in the world. So saying that, there leaves, according to me, there leaves a very little space for further direct tax code, because this code is already been codified in this new act. Right, we should not say it is bill, because the Honorable President has already signed, so it's an act. So this new act will continue, and it covers possibly every suggestions given by the trade and industry over the period of time. So that's my opinion. I don't foresee, but yes, I foresee a more better quality of the rules to come into it, and that will only give a comprehensive position of the direct tax structuring in our country.
Sir, one more question. The participant hasn't stated his name. His question is whether foreign posting allowances paid to an employee in foreign currency who is posted in a foreign country needs to be considered as a part of the taxable income by the employer, where such employee is ordinary resident in India under Income Tax Act 2025. And has there been any changes in this provision in the 2025 Act as vis-a-vis the 1961 Act?
No, Section 9 and the corresponding provisions of the taxability in similar situation, there is no significant amendment or significant change. If the employee remains as an resident for the period of stay in the foreign country, his income shall be taxable in India. There is no question into it. However, the DTA provision remains unchanged. That means the tax levied by the tax authority or the revenue authority in that other country, if at all, right, with a TRC tax residency certificate, right, the corresponding this double tax shall be avoided. There is no doubt into it that double tax shall be avoided, and this double tax shall be avoided by claiming this TRC and the tax credit challenge in our country till his Indian residency status continues.
Thank you, sir. And no more questions regarding the Act. So should we end the session, sir?
Yes, sir. If there is no other question pending, no other question remain, we can close this session. Thanks to all the participants for your patience hearing, and thank you everybody.
Thank you, sir, for your time and your deliberation. We look forward to many such webinars. Thank you so much, sir. We are ending the session.
Thank you, sir. Thank you, sir.